Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, investment consultants, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please check out our website at dakota.com. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Well, I am thrilled to welcome to our Philadelphia studios Renee, Hanna, and Kailey Ransom from Baylor University's Office of Investments. The Office of Investments is responsible for managing Baylor's endowment and other long-term investments of the university. The $2.1 billion endowment portfolio supports the affordability and quality of a Baylor education today and for generations to come. $91 million was distributed from the endowment to the university over fiscal year 2024 in support of scholarships, professorships, and other mission-related activities of the university. Renee and Kailey, welcome to Philadelphia.
Thanks for having us.
Yeah, thank you so much. It's wonderful to have you here. To my right, as always, Steve Aiken. Wonderful to see you.
Great to be here.
Thank you for being here.
Of course.
We're calling the game today. We're very close. Usually we're across from each other.
Let's make it happen.
Let's make it happen. But we're so excited to have you both. So thank you for being here. Before we get started, I'm going to read your biographies for our audience. Renee Hanna joined the Baylor University Office of Investments in May of 2008. She currently serves as Managing Director of Investments and is responsible for the endowment's private investments across all categories and geographies. Prior to returning to her alma mater, she was an associate investment analyst at Lee Financial Corporation, a multifamily investment office. Renee graduated cum laude from the Baylor University Hancomer School of Business and earned her MBA with honors from the Macomb School of Business at the University of Texas at Austin. She also holds the Chartered Financial Analyst CFA designation. Kailey Ransom joined the Baylor University Office of Investments in August of 2023. She serves as an investment analyst and focuses on private investments. Kailey received her BBA from Baylor University. She graduated with majors in business fellows, finance, marketing, and Spanish. Renee and Kailey, thank you so much for being here. Congratulations on all your success. Kailey, congratulations on the relatively new role.
Thank you.
And thank you for being here.
Thank you for having us.
So the trip was okay?
Yes. Yeah, it was great. Easy flight in.
Oh, that's good. And you're here in Philadelphia for a few days?
We are.
Okay,
yes.
Good. Well, we always appreciate when investors get to come to the desk and spend time with us. So we're very appreciative that you're here. Well, you both spent the formative chapters of your lives at Baylor University at different time periods and studying different things. Can you tell us a little bit about what those early years at Baylor were like for you, how you were thinking about your careers, thinking about what you were studying? We have a lot of students who tune in, so they always like to hear the early days.
Early days for me, I actually grew up in Waco. My family moved there in the 90s, and college was always aspirational for me. I was the first person in my family to go to college, but I was going to get there through athletics. So I had a softball scholarship to a junior college in town, MCC. And after that, I had an academic scholarship that got me to Baylor. I had high hopes of walking on the Baylor softball team, and those dreams were cut short. And so after getting rejected, I decided to lean into academics and channel that competitive energy into business school and ultimately into a finance degree.
What was that like for you, being the first in your family to attend college?
It was great. I had great parents who it was always the goal. And so I knew that was one of the reasons why they moved to Waco, was to give us a better life and to get us into college, and just had a dream for us. And so to be able to see it play out, it was meaningful for me, meaningful for my family, and just like really close to the mission for what we do, because scholarships is why I was able to attend college. And it's been transformative for me and for my family.
Great. No club softball?
I'm actually coaching my daughter's softball team right now, and a little too intense. I'm trying to rein it in.
Trying to dial it back.
Yeah, trying to dial it back.
That's great.
Yeah.
Thank you for sharing all that. How about you?
Well, I grew up in Scottsdale, Arizona, kind of outside of Phoenix, if you're familiar. So looked at colleges, wanted to go out of state. Apparently, I wanted more humid than Arizona. So I ended up in Texas. I just loved Baylor, the culture there, the faculty, the students. I think there's just an element of kindness and true caring environment at Baylor that I didn't really see anywhere else. And so I went there for college, and I was really interested in marketing. I still do enjoy kind of learning about the consumer, and that drew me towards economics. And then I also majored in Spanish. It turns out my passion for econ was very short-lived, and I switched to finance shortly into my time at Baylor, and really loved finance. I think around my junior year is when I started to think more about careers in that field. But yeah, I loved my time at Baylor, and stuck around.
How did you get exposure to the Office of Investments? Were you studying it within the classroom, or what was that kind of the first exposure to the group?
Kind of applied on a whim for Baylor has a student managed practicum class. So I applied for the small cap investment class, and we split the class up into teams that were assigned different sectors. And so I had the finance, utilities, and real estate sectors, and was super interested in that. I think in college, I set up a Robinhood account, but beyond that, I didn't really have much experience with equity analysis. And so that was kind of my first hands-on experience with that. And I thought it was super interesting. And the class was actually taught by Renee and our CIO, Dave. And that was kind of my first touch points with them. And then had conversations later on in the year that they were potentially hiring an analyst, and I was that analyst. So here we are now.
Congratulations.
Kailey's being humble. So we were not hiring per se for an analyst. We knew that we at some point needed to expand, but it wasn't like there was a job description out there. And so Kailey got up and was speaking about the financial sector and broke it down in such a simple way as to, here's how these banks make money, and just did a really nice overview. And to me, if you can be super concise and like share an idea and like help a class full of students understand, and the poise with which she did it, it was just incredible. And so Dave was actually not there that class, but I was like, you really got to check out Kailey. And Kailey actually had another gig. And so Dave went to work, and we were able to poach her and bring her to our side.
Congratulations to you as well.
Yeah, it was a win for sure.
Yeah, it sounds like advice that a lot of asset managers could take as well, being clear and concise and explaining what they do. So
yeah, it applies to a lot of things.
It does. That's great. I appreciate you sharing that. And congratulations again. It sounds like it's well worth it.
Thank you. Yeah.
So how about you? How did you end up finding the track towards investments?
So actually a very similar way. So I was leaning towards accounting, mainly because I knew what accountants did and was like, sure, this is great. I know, I understand it. And then I just had some really great mentors, some academics who leaned into me after I took a finance class. It was like, hey, you should check this out. Here's some opportunities. And I too was in the practicum class. And so I was in the same class that Kailey was in a similar seat. And I was doing what you do and looking at the job offers for like consultants and investment banks, and kind of going the traditional path. And then my advisor at the time was like, hey, you should come see what we do, and ended up leaning into the multifamily office, which at the time was Lee Financial. And so I was in an asset allocator role there as an analyst, and then kept in touch with the CIO at the time. And so when I found myself moving back to Waco, it happened to be at the time they were expanding the endowment team, and there was an analyst spot. And I was like, I have to get that job because there's no other financial game in Waco, Texas. And so it all worked out.
And it was May 2008.
It was May of 2008. Yeah, things got really interesting thereafter.
I can imagine.
Yeah.
I think both of you, a little trial by fire. I mean, private markets is relatively new for you. It sounds like you had a public market background when it came to the undergraduate work you were doing, and now private markets with the two of you. Would you mind, for the audience's benefit, just kind of giving a little bit of an overview of Baylor's investment office, Renee? Just the the structure, the organization, just to set the stage for us.
Yeah, absolutely. So as you mentioned, we're a $2.2 billion endowment. We split the house publics and privates. And so across the team, Kailey, myself, and Jen are managing the private investment portfolio. On the other side of the house, the marketable side, Dave and Maggie are running that portfolio. And I think what makes us a bit unique is that, oftentimes you have the CIO and then it's split and you've got the managing directors underneath. When Dave took over as CIO in 2020, after being with the endowment for about 10 years, he kept his day job. So he continues to trade the marketable portfolio and lead that, spearhead it with Maggie. And I think it really makes us different because we're nimble. It's a more flatter organization. The two sides really talk to each other and collaborate. So neither of us are trying to maximize our silo. It's holistically running the portfolio and thinking about the trade-offs of public versus private.
That's great. Thank you for sharing that. How do you explain the mission of Baylor University to someone coming into the office for the first time? An asset manager, a GP is sitting down. What does that conversation sound like?
For us, just thinking about the purpose for the endowment, it always goes back to the stakeholders, and the students are the ultimate stakeholders. So when we think about, what happens if we double the endowment, we break it down into dollars. If you're getting a $15,000 scholarship as a student, that $30,000 is really impactful for you. And so it's pretty easy to just, when GPs come into our office, to have that discussion. It's tangible. You can see it. You're sitting at the university, you're sitting in our offices. Everybody on our team has been a recipient of the Baylor University scholarships, or at least 5 of us. And so it's pretty easy to explain, and it's a powerful statement.
How has it been for you teaching and giving back to those same students that the mission benefits?
Yeah, honestly, the real answer is it's been really hard. Teaching is a really intense, time intensive job. And so we love it. It's great to be really close to the students. We've actually had to pull back a little bit just because it's been tough to give the time that we need to, and are hoping to revert back. But we found Kailey through that effort, and we're going to continue to stay close to Hancomer, but probably more in a advisory capacity going forward, as opposed to a dedicated academic professorship and leading those semesters, because it was pretty intense.
I can imagine.
Yeah. At one point, Dave and I looked up, I was like, I don't know that we have enough time to think. I feel like we're just constantly running from one thing to the next. So it was tough to juggle, to be honest.
That's great that you did it. I'm sure the students appreciated it.
It was great.
And those experiential opportunities for students, I find, always stand out. So it's great that you've both had the opportunity to experience that.
Yes. Yeah.
So there are last time I had read, 75 external managers. Is that still the number in the portfolio?
I think on paper, there's probably 75 managers across the portfolio, but we run a pretty focused book. So of the names that matter on the private side, it's more like 20 high conviction names that we lean into.
That makes sense.
As you know, on the private side, it can take a minute for those legacy positions to roll off. But there's 20 names in our portfolio that we consider high conviction and intend to invest with going forward.
With that private book, getting back to the organization and the team, how are the two of you working together? So when you think about your relationship, identifying sourcing managers, doing the due diligence, or doing trips like this, what does that dynamic look like?
At first, it was just myself, and I was building out the portfolio, the private investment portfolio, and really in earnest in 2012. Once Jen Digmore joined, she joined about 8 years ago. After about 4 years, as we were thinking about how we increase her responsibility and how she can take leadership, we were having discussions about what that looked like. And initially we started with, what if we carve off this piece of the portfolio and it's yours, and I'll take this. And so you can have, maybe the real estate allocation, and I'll take the private equity allocation. After kind of trying to prosecute that for a couple of months, it was pretty evident that it's not going to work. This is such a relationship intensive business to say, here's this manager that, I've known for 10 years. Now you take it. It just doesn't work that way. So the way we're prosecuting it now, we have a stable foundation of GPs. I mentioned we have 20. We typically have capacity to add 1 to 2 new names each year. And Jen and Kailey lead that effort. So anything new that comes in the office is going through them. And then ultimately, once we get to kind of the final selection, we huddle up and determine if it's the right fit. But then they own that relationship cradle to grave. And ultimately now we've got a handful of names that Jen has brought into the portfolio. Eventually, Kailey will do the same thing, and then they'll own that relationship going forward. And for us, it's just been a better way to grow and have those responsibilities, aside from the, all the manager meetings that they're taking, but it really allows them to be accountable for the recommendations that they're making.
Kailey, when you think about what makes a Baylor partner from a qualitative perspective, so now you're taking those calls from a manager who may not be as familiar with Baylor, what are you looking for in that partner? What are those must-haves that are necessary when those calls come in?
I think our biggest non-negotiable is integrity. I mean, we come from a faith-based university, and we're looking for people with those really strong morals and values that eventually, they're providing capital for our students and we're trusting them with our capital. And so I think finding those people that there's no question about their moral compass that they're investing behind. So we actually do a pretty deep reference checks in terms of due diligence. We'll typically ask for a friend within the industry that you've known for decades, possibly a friend from childhood, and then a neighbor, typically. And we'll do that for as many partners of the firm, or at least the key man of the firm. And so we do upwards of 30 to 40 reference calls on any particular manager that we're bringing into the book. And I would also say some institutions that might be the last check that they do, but for us, it's kind of the first when we start our due diligence process. Obviously, returns are important and we're looking at those metrics too, but integrity is someone without integrity it's going to be a non-starter for Baylor. So that's something that we're checking very early. And there's times that we haven't made an investment because someone didn't pass that threshold. So it's very important to us.
Interesting. I have a feeling there are a lot of portfolio managers right now who are going to be calling their neighbors to make sure that the relationship is in good standing.
Right. Yeah.
So it is very helpful. Thank you for sharing that. Other than the background checks and the referrals, though, is there anything else that you look for in those conversations when you're trying to identify, you're quantifying something very qualitative? Are there any other things that you look for? Any questions that are, kind of the key questions that you try to hone in on?
Mm-hmm. I think we're we want to partner with people who have integrity, but we also want to make sure our incentives are aligned. And one of the things we're trying to look for is what is your chip? We want people who have a chip on their shoulder and have a purpose that's beyond money, right? Because that's ultimately only going to get you so far. And at some point, you're going to make so much money that you're going to stop hustling. And so we want to find the people who are incentivized beyond that and motivated beyond a different purpose. And it's different for everybody, right? Like the person who, maybe grew up wealthy has a different chip because they're trying to prove that they can do it on their own. The person who didn't might be trying to prove that, to somebody that he can, right? So it changes based on who we're talking to. And there's a lot of different ways that, people find their purpose. And so we're trying to find the why behind what they do.
So you touched on kind of the qualitative, what you look for, and then you juggle that with the performance base. You have to ultimately perform, right?
Sure.
Would you be able to share an example of kind of where qualitative insight proved critical? Like, okay, so they checked out qualitatively, performance-wise, but so did this other manager. How do you ultimately make that decision when it's kind of neck and neck? Because you do pick one or two managers per year. It's a pretty intense bar that you probably have to hit. So just curious to hear your thoughts on that.
Yeah, we do have a high bar. We have room for one GP, right? And there's a ton of great GPs. Just because you don't land in our book doesn't mean that you're not a phenomenal manager. So something that might take you over the edge is we do run a concentrated portfolio. We want each of our underlying portfolio companies to roll up and be approximately a $3 million position. And that's ultimately going to continue to increase as the endowment gets bigger. And so if I'm looking at a GP who's raising $200 million and our check size right now is 20, we're having conversations today. When you raise fund 2, can I get 30? When you raise fund 3, can I get 40? And at the same time, I don't want you to grow that fast. I want your fund size to stay small because I think that's where the dislocations exist, the information asymmetry exists, and we want to be able to take advantage of that. And so, that's a big ask too, right? I want you to stay small, but I want to get bigger. Are you going to be able to give Baylor that access going forward? And we've walked away from some great groups who said, no, you're going to get your pro rata increase going forward because we need to diversify our business as well. totally fair, but we're not a good fit.
Does that approach lead you to more emerging managers, younger managers in their life cycle?
It does. I mean, when we onboard a new GP, we want it to be a relationship that has legs. We don't have a farm team. And so for us, we want a group that we can grow with. I think the opportunity really exists in the lower middle market, and we define that as sub $1 billion and preferably sub $500 million. So we're trying to bring in groups that are sub $500 million and GPs funds 1 through 3. From a relationship standpoint, the information asymmetry benefits us as well. So if we can be the first call and really have a collaborative partnership with our GPs, which all of those 20s we do, it's a lot easier to build that trust when you back them early, because we're saying we have trust in you. And if we're coming into Fund 4, I mean, they've already been proven, so it's harder to establish that.
Funds 1 through 3, particularly with early stage managers, a lot of times they're building out the operations while they're building out the funds, kind of riding the bike while building it. How do you approach operational due diligence? It's usually the last thing we ask, but I find particularly with emerging managers, it likely is earlier in the conversation than a more established GP.
I mean, there's plenty of great third-party service providers out there, right? So that should be a non-negotiable upfront, and they should be able to figure that out and get that ironed out. And so that's a non-starter if you're not running an institutional process. Typically, when we've backed funds early and things have gone sideways, it's more around fund optimization and sizing. And we tend to, if the investments are good, we are not going to not come into Fund 2 if you get that a little bit wrong. It's like, are you willing to learn and get those lessons right? So we're having those conversations with them. Again, this is where the collaboration comes in, because we've seen it before. We want to be able to chime in and have discussions around sizing. But ultimately, when you talk to people who are rolling from Fund 1 to Fund 2, and Fund 2 is really like Fund 1.5, right? Because we've seen execution, but we haven't seen realizations. The lessons learned tend to be around portfolio optimization, managing reserves, getting the fund sizing right.
That makes sense. Kailey, you mentioned background checks and reference checks when you're evaluating integrity. How about during that same process, speaking with and working with other LPs? What does that conversation sound like or look like as it relates to the folks that you're investing alongside with?
I think that's a big part of it. I think it's leveraging your own network, talking to other LPs that we know who might have some touch points with the manager. There could be more qualitative things within that. There could be more experiences that certain people have had. And it's all, I think, just helps us build that picture of who is this person that we're investing behind, and what is this firm going to be in 10 years, and what are some of the frameworks that they're putting into place now, and what will that look like in Fund 4? And hopefully we'll still be an investor at that point, because that's the long-term lens that we have when we're underwriting these new groups. So it's definitely a big part of it, I think. And we're thinking of that too as well when we're enhancing our own networks and thinking of what overlap do we have with, other universities or hospital systems, and who can we, who can we cross-reference this GP with, and, make sure everything seems to be checking out from an LP side as well.
Thank you for sharing that. I'm curious, in the last 2 years, when you're having those conversations, what experiences or resources have you developed that you feel have been instrumental in helping with those discussions?
I think exposure is the most important part. I think when I first joined, obviously I was out of college. I didn't really know what I was looking at when meeting with GPs. So I think the more that I met with and talked to our team and listened to other LPs and saw like, okay, well, how are our viewpoints as an office different than another endowment or foundation? And why is that different? And why is nobody technically wrong, but why do different institutions have different needs? And that kind of helped me develop a picture and a framework of what would be the right GP for our book, what would be the right strategy for us, who is the right fit culturally with our endowment and our needs. And so I think, the more exposure I had and the more that I met, I think I was able to kind of develop that picture easier. It still is a changing mold as the world changes, the private markets change. I think environments are different, and, managers kind of sink or swim through that as well.
A good point on private markets changing. Have you been finding more opportunities, Renee, overseas? Or is it still primarily or mostly focused on domestic managers, or are you starting to see more opportunities arise outside of the United States?
So for us, we've had a long-term view on emerging markets in terms of how can we appropriately execute that strategy, and our view has been we cannot. We're a team of 3 on the private side and 5 on the overall investment team, and so. I mean, a decade ago when everybody was chasing down emerging markets, we took a look at it. We had conversations with teams who were 2-3 times our size. And, the feedback was it's really difficult. And we continue to have a view that we want to be lower middle market. We think that's where the dislocations are. We like groups who specialize. And so do we really think that we're going to be able to find that GP overseas? Maybe. I mean, we have great networks. We can collaborate with other GPs and LPs. We can probably find those diamonds in the rough. Do you really think you can get the access that you need and then monitor as you need to going forward? Probably not. I mean, that's a really big ask to be able to go overseas and stay on top of things as we need to on the frequent basis. And so I think it was just a reality check for us. Can we execute? And of late, I think it served us well. Obviously, emerging markets has been a challenge from a liquidity standpoint, and being domestic has been a good trade. But ultimately, it came down to can you execute and be great at this? And we felt like we could not.
Do you have a view on GPs being specialists versus generalists? So when you look at someone who's very specific in a sector or industry versus someone who does or can opportunistically go overseas or opportunistically go into a different sector that they may not have had as much exposure to?
Mm-hmm. We do. So we have a very kind of, I'll call it top-down, bottoms-up approach to how we build out the portfolio. So within the private side, our reason to exist is really to generate, octane for the portfolio. So our net IRR is a 15%. Our hurdle is a 15% net IRR. The way we got to that is if you think over the long term, the public equity portfolio can generate a 6% return. Mm-hmm. We want a 350 basis points premium to that. So that gets you to 9.5. And then we add an opportunity cost layer on top of that. Do you think over the next 4 years, there could be a 20% decline in some particular asset class that you cannot be tactical because your capital is tied up on the private side? That's another 5%. So that gets you to 14.5 and we round up. So that's a pretty high bar already just to get into the portfolio. So then we say, what sectors do we think have, long-term growth trends that can be a ballast, over a 10-year fund cycle? And we lean into technology, healthcare, and consumer. Mm-hmm. So we focus on those 3. And then within that, we do believe that specialization can give you a tilt and help you add alpha if you really understand, that sleeve and can lean in and speak the language when you're talking to different companies. All of these industries are highly competitive. The lower middle market, while it might have dislocations, is still incredibly competitive. There's a lot of GPs out there, and we think that can give you an edge. And then we build the portfolio from the bottoms up based on GPs that are a fit for all the reasons that Kailey mentioned.
That's very helpful. Thank you for sharing that. So how do you balance risk management with all of that? So you want to deliver the returns, you want the growth, but you still have to be risk aware. So how does the overall, you could say, portfolio management look like as you're thinking about the risk versus the reward?
Sure. I think on the risk side, I mentioned our allocation is, roughly 50-50 publics and privates. And today we're actually 55 public, 45 privates, but we didn't start there. So our private investments have been creeping up and adding that illiquidity to the endowment, but we've been doing it with vintage year diversification in mind and getting to a position where we're cash flow neutral. So if you look at our portfolio, we've really been building it out over the past decade. And in years like the past 2, where, the bid-ask spread has been wide, transactions are thin, we're not seeing a ton of M&A, and distributions have absolutely slowed down. We were still cash flow neutral, and in some cases cash flow positive, which gives the marketable side of the portfolio the wherewithal to be tactical and take advantage of opportunities. And if we feel like things are getting too rich, which over the last, 6 months, we have been pulling back on our equity exposure, then we're parking it in cash and using that as our risk mitigation tool. Because once you've made a trade on the private side, you don't have that ability anymore. So we're really doing it in a holistic way with the marketable side.
As the lead of the private investments team, it's broadly diversified across, your typical private equity, real estate, real assets, I should say, maybe some venture capital. How do you approach a new opportunity because you have so many GPs calling in to you. You ultimately pick one at the end of the day. What does that process sort of look like at the beginning? And on top of that, what is most interesting that you're seeing over the next 6 to 9 months?
So there is a lot of places that we could play, right? Like when you're an allocator, you can do anything, and there's a lot of different options, and it's a really wide universe. To help us with a small team to stay nimble, we start with that framework. So where do we want to play? We've got, typically we're allocating $150 million per year. It's our capital budget across private investments. Where are those dollars going to go? And so we actually have cut out a lot of categories. We don't invest in private real estate anymore. We looked at the returns. They didn't meet our hurdle. And so we have a public alternative that we can invest in, right? If we see a tactical opportunity, we can lean into REITs. So we don't have to do it on the private side. Same thing with private oil and gas. We do have exposure, but we also supplement that with the public side. So that's one where we have both. Infrastructure is another category that we've ultimately scratched because it doesn't meet our hurdle. And we've never invested with private credit for similar reasons. So, right off the bat, we can just quickly say, thanks for reaching out, but this is just not the categories in which we're focused right now. From there, we look at the 3 that I mentioned, tech, healthcare, and consumer. We really want to be in funds that are sub $1 billion and preferably sub $500 million, funds 1 through 3. So that's another area where we can lean into, if you're fund 7 and you're raising $2 billion, it's not a fit for us. And so we can easily have that discussion with them and give them a quick no versus wasting their time. And then we spend a lot of time thinking about, venture capital versus the other categories, what I'll call expansion capital. We think of it more like bootstrapped middle of the country growth equity and lower middle market buyout. And we tend to lean into funds that are concentrated. They have a lower loss ratio, a repeatable process, and higher velocity. So we want groups that are going to give us our money back because we believe in the compounding component versus a longer duration. So we're happy to supplement and take the trade-off with a lower multiple on invested capital if you can give us that capital back faster versus a really long duration early stage venture capital exposure. So venture tends to be roughly 20% of what we do, and the remaining 80% is going to be in expansion capital and lower middle market buyout.
So tell me a little bit more about a bootstrapped middle of the country growth manager.
Yeah, so we've got a few in our portfolio. Is one of our favorite spaces to play. It can be a company profile where they're growing 30 to 50%, and you're a minority position, but you're taking 30 to 40% stakes, and you're giving the founder some liquidity, but another bite at the apple. And it tends to be a founder who himself has said, I've taken this business as far as I can go. Now I need help to get it to that next stage. And they're choosing a partner to come in. And it's truly a collaborative process. The groups that we've backed tend to be very, operator focused. So they've run companies themselves and they have a true value add proposition and a reason to exist beyond just being a, financial capital provider.
When you think about the operator versus the investor, are there different characteristics that you look for? And beyond the obvious that someone has, operated a business, has launched a business, has run the business, probably sold a business as a result of what they're doing now, versus the pure investor. Are there different characteristics that you look for, maybe different insights that you try to glean?
I love it when you have both, right? Like that's kind of the holy grail. If you can find somebody who's both been an operator and you have a visible track record that they're also really good at investing, because I think that's powerful. I've never been an entrepreneur. I'm not a founder, but I can only imagine when somebody sits across the table from you, has run a book of business, understands the terms, understands the challenges that you're going through, all the way from, mergers and acquisitions to HR issues. And then you can also see their track record, and they've taken companies to the next level, gone full cycle, had realizations. That's a really powerful discussion when you're getting hit with a ton of inbounds, for people who want to invest in your business. And so ideally we want to find people who have both of those attributes. And there's several out there. There's a ton of great growth equity managers that are operating in this space.
Being a leaner team, you have a lot going on. Do you prioritize fund opportunities that offer co-investments? What's your view on co-investments in general? And how do you, how would you weigh that as part of the process, when thinking about potentially investing in a fund manager?
So we have strong views on co-investments, and they're counter to, I think, what everybody else is doing with co-investments right now. We've done a few co-investments. I think we're good at it. We're not great at it. If I was evaluating our portfolio today on the co-investments we've done, I'd probably say it's too early to tell. So we'll see how it ends up. It's going to be just fine. But I think we're not great at it. And so I think that you should either do every single co-investment that comes your way, or you should do none of it, because there tends to be some adverse selection. And I've heard anecdotes from, people who work at KKR and can invest in every single co-investment, and they pick and choose the one that they think is perfect, and they just completely got it wrong. Like, they would have been better off if they do everything. And so with that view in mind, it's really hard to cash flow manage around doing every co-investment opportunity that may or may not arise. And so we've taken the view that we are no longer going to invest in co-investments. We're going to upsize our fund commitments and get them to the point where the underlying portco is $3 million. And we, in turn, want to lean into GPs who take that same view, where the best ideas are going to end up in the fund, and they're not trying to cater to LPs who are really banging the drum for co-investments.
With that in mind, when you think about the public market book, how concentrated are your portfolio managers when it comes to public equities? Are they highly concentrated, so their best 5 or 10 ideas, or their best 2 or 3? How do you think about diversification versus concentration? So
we do run a more concentrated marketable book as well, but it varies. All of our public exposure is active management. Mm-hmm. We have groups that are managing a 30 stock portfolio. We have groups that are much more concentrated. And so it really just depends on the expertise of the GP. And there we too invest with specialty. So we've got specialized groups on that side as well. Dave runs the portfolio kind of like a baseball team. Everybody has a position to play. And as there are opportunities in the market, he's very tactical with how he rotates capital.
And are you getting involved from a coaching perspective?
Absolutely. Yes. Yeah. No, he's very collaborative with all of us.
That's great. Yeah. I appreciate that you're sharing that. Is there any fund to funds exposure in the portfolio?
There's not.
Okay.
No.
Curious if that when you're looking at earlier vintages, particularly Fund 1 through Fund 3, I was just curious. It seems like more fund to funds are popping up these days. It feels like, after 2008, they kind of went away for several years, but it feels like they're back for a variety of different reasons. So yeah, I appreciate you sharing that. Well, you built a portfolio based on global diversification. Are there any specific sectors or industries other than the 3 that you mentioned before that you're doing a little bit more work on today?
Yeah, there's a couple in our portfolio that we are. It's a little too early for us to share.
That's
so
okay.
Kind of propping up a new asset class within the endowment. And then just continuing to lean into those 3 sectors. Obviously, there's nuances with each. And so, everybody's talking about AI. We do not have a dedicated AI manager right now, but we continue to vet one for the future. It obviously, is something that you can't ignore. Our, vertical market software players are seeing it as a way to optimize the portfolio companies. And so we're seeing margin expansion, more efficient growth coming out of that sector. So right now it's really more of a tool that our GPs are taking advantage of. But, we're all over it, just like everybody else, trying to understand, how it fits into the portfolio, who's using it effectively. But we have not invested in any of the dedicated funds that are out there yet.
Do you feel being in Waco gives you a different perspective on private markets?
I think it gives us an edge, perhaps.
Okay, the Waco edge.
The Waco edge,
like
yeah. Because we travel quite a bit, right? So you go and you come back with all of this knowledge, but then you aren't surrounded by the noise. And so you can sit down and think and be like, here's what we think about what we just heard, versus constantly being kind of immersed in the space with your peers and like second guessing, like, I'm doing this so different, because I feel like we do a lot of things different. And so, sometimes you can question why you're doing things so different. Everybody wants to be a contrarian investor, but at the end of the day, it's really hard. And so when you can go back to Waco and be a little bit isolated, execute the plan that you think is right for your business without kind of hearing about how everybody else is doing it in a much different way, it's probably a little bit easier versus having to go to a happy hour and constantly hear about why you're wrong.
When you think about your relationship with Kailey, maybe again, I'm going to keep asking you to coach. With coaching and mentoring, what are you looking to share with her that you hope she'll be able to bring into those meetings, into those conversations, to give her the Waco edge?
Mm-hmm. I mean, obviously, I want to be a good role model, right? And so I think leading by example is something that everybody in our office strives to do. But I think what we can do best for Kailey is just give her reps, right? Like, the pattern recognition in this industry is real and it comes with time. So how can we shorten that duration for her so that she can get up to speed quicker? So we're big proponents of, as soon as you get in our office, you're going to travel. So she's going to all the GP meetings that we're going to. She's in every single meeting that we're in. And then also just lending my network, right? It takes a long time to build these relationships. And so if I go somewhere, or if I'm going to a women's investment summit, it's like, hey, I'm bringing Kailey, and like everybody gets to know Kailey. She's awesome, right? Like, how can you just kind of open up your Rolodex and get her up to speed and entrenched with the industry that just takes time to build, so that she can get there and ramp even faster than I did. And I know Jen is like ramped way quicker than I did. Kailey's going to ramp way quicker. So if everybody can just level up on the way up, it's going to make the endowment better.
As you're ramping up, so any surprises that you've learned, or anything that you weren't ready for that, has made you rethink maybe the role a little bit, just what to expect?
Part of it was being a student at Baylor, and then, kind of turning to the faculty admin side, you could say. I think there's a lot that goes on behind the scenes that you don't realize as a student. In terms of our office, I think, I had a lot of friends start different jobs, but, entry-level positions, careers all starting at the same time. And I think I realized very, very quickly how impactful it is to be on a really small team, or a lean team, rather. I think being able to sit in on meetings and travel with Renee and Jen, I think if there were 10 of us, that wouldn't be feasible, but there's 3 of us. Mm-hmm. And so I think I get to take up that third open seat in the room that I might not be able to if there was another managing director on the private side, or, more tenured individuals on our team. So I think it works out for me. And that was something I didn't necessarily anticipate, but I think learned very quickly also just how valuable it is to be able to travel and have in-person meetings and meet with people and kind of learn about how Renee's conducting meetings and how questions Renee's asking that maybe stumps people a little bit, or maybe provides insight that I wouldn't necessarily think to ask about. So I think it's been really interesting as I've kind of hit this inflection point of learning within the office.
Renee, what is a question that usually stumps a manager?
I mean, I don't think I have any. I don't think I have any. I know. I mean, I just don't feel like I stump people very often. I don't know.
We meet with a lot of really successful individuals. Mm-hmm. And I think that question about what's your chip on your shoulder? Mm-hmm. Why do you still want to do this? What's driving you is like a really simple question. But I think a lot of feedback we get is, oh, I haven't actually thought about that. And, it's not just money for most people. It's there's real incentives behind that. And that's a question that always, I think, comes out.
Maybe the question is like, can I talk to your neighbor? And they're like, what? Like, this is not why we hired Kailey, but her consumer knowledge, I mean, she is our ace in the hole when we're evaluating like consumer products. Half the stuff like Jen and I maybe haven't even heard of. And Kailey's like, oh yeah, like this is like all the rage. Our friends are using it. Like, I mean, it's just like an ace up our sleeve when we're evaluating consumer GPs and if they have good brands in their portfolio. It makes there's a generational gap for sure.
There is. Yes. That's great. That's great that you can bring that in.
Yes.
Another question, Steve's going to ask you about the underwriting process, really kind of just taking us through a little bit more granularly, step by step. But something I always think about, I'm asking you all these questions and I'm trying to understand how you think about, the allocation model that you employ at Baylor and how you select a manager. How do you know when to stop asking questions and when to make the decision? When is enough? Because I would assume in your role, it's probably limitless how much due diligence you could do on a manager. So when do you put kind of the clock to a stop and know when it's time to deploy capital?
I don't know that I have a great answer, to be honest. I mean, so many times you meet with a GP in the first 10 minutes, you just get that feeling, right? There's just like good vibes. I want to pursue this further. I'm thinking of one manager in particular. We had one meeting. It was a fun one. It was a GP recommendation that said, hey, you should check this out. And within the first 5 minutes, it was just like, this is going to work. It was kind of trading advice for equity. They were longtime operators. They had a very articulate sandbox with which they were going to play. They had all worked together for a very long time. It filled a gap in our portfolio. So the timing was right. We didn't have any exposure like this. And so we got to work very quickly. We did all of our reference checks and asked the right questions, but I knew we were full steam ahead. And I think there's other times where it's like, a test that Jen and I talk about oftentimes, like we'll come in and she's, vetting a GP. And if you go to bed and you can't stop thinking about it, then you need to lean in. Sometimes you have that first meeting and you're jazzed and you're excited and you like what they're doing. And then a week later, it's like, oh, I haven't really thought about them. Well, then we probably don't need it, right? We don't need redundancy. It might not be complementary. And so I'm sure they're great and we'll be successful, but like it's probably not a fit for us. So it's okay to go pencils down. Maybe it's easier to know when it's pencils down. Yeah. I don't know.
So after that first meeting, hypothetically, you have a great feeling about it. How do you take that to the broader team? And when you do make that final decision of making a commitment, is that a team voting effort? Do we have to sound that off to the board? What does that sort of look like?
So I think this is where our size comes into play. Oftentimes we've all been in the meeting, or Jen and Kailey have been in the meeting and then they bring me in. And so the fact that we're so small allows us to be super collaborative on the fly. I mean, we're having discussions in real time throughout the day, text messages, emails, phone calls. I mean, there's just like, it never ends, right? The different ways people can reach you. And then, Dave is a really great leader who gives us a lot of autonomy to run our private portfolio. And at the same time, we're constantly talking about what he's seeing on the marketable side. So we know what we're giving up for the illiquidity and the trade-offs. And so once we're ready to make a recommendation, Dave is fully supportive. And so he'll go in and meet them oftentimes after the recommendation has been made. But we've all met, we've all collaborated, we all know about it, but there's just a lot of trust in the office because of the continuity and the duration with which we've all worked together. We also are really fortunate to have a supportive board. So our investment committee has similar continuity. We have a lot of trust there. And so their willingness to meet ad hoc if needed, to meet the timing for a recommendation because there's going to be a close or it might be short order. But we do need their formal recommendation and approval. And they've been a really great supportive board for us. And it's just a lot of trust all the way around. I think that comes with the continuity that we have throughout the institution.
So you've been with the investment office since 2008. So when you think about those years up to today, so what's changed as it relates to, how you approach investments, how you approach the job, and maybe how Waco has approached the university?
So there's been a lot of things that changed. I think when I joined in 2008, it was a very different portfolio that we inherited. Today, when you fast forward, it's established. And we've built a really nice foundation. And so to see kind of the fruits of your labor and everything that you've built out and see everything come full circle has been really incredible to see that growth. I think the change for me has just been, obviously there's constant refinement and optimization. So I could think about the portfolio. I think we're on version like 5.0 right now in terms of like the tweaking that you do on the margins. But I think it's just the conviction that you have and the willingness, like when I say no, like I oftentimes don't get buyer's remorse and I don't get seller's remorse either. Like if you decide like to walk away and they do really well, it's like, great. There's plenty of GPs with which we can invest. Kailey said it great. Different institutions have different needs. So what might be a great fit for another endowment, it's okay if we decide to go in a different direction, but just the willingness to kind of walk your own path in terms of how you construct the portfolio and the confidence in that.
When you think about those fresh perspectives that Kailey's bringing, in addition to consumer brands that you may have never heard of before, what have you found, or what do you encourage your younger staff, your earlier staff in their careers to bring to the table as it relates to innovation and thinking about new things?
I mean, we want everybody to have a voice. So everybody has a vote in terms of, what we're doing. And when we have our, investment roundtables across the team, everybody's voice matters. And I hope Kailey feels that when she's here to speak up and be like, I don't really know how I feel about, this that they said. And so I think that's just the empowerment and the ability for her to, if she sees a flip book and a GP is interesting, she doesn't have to come to me and say, can I set up this meeting? She just picks up the phone, sets up a meeting. If it's interesting, she pushes it through to Jen and I. So just empowering her to feel like she can, chase ideas down.
You feel like you're able to chase?
Yes. Yeah. Mm-hmm. I think immediately after I started, Dave, our CIO, used to come into my office like almost every day, say, is there anything that doesn't make sense to you? Is there anything that you don't think we should be doing it the way we're doing it? And I mean, he's the boss. So, growing up in a corporate environment, interning and jobs in high school and whatever, then coming and having, the person in charge coming in every single day saying, let me know if you don't think it makes sense the way that we run things, or not even strategy wise, just operation, anything. And he was like, I want to know from your perspective, you have a fresh set of eyes. If I'm meeting with a manager or we have a manager in the book and you don't understand why they're there, I want to know that. And so he is very empowering, and he speaks that way to everybody on our staff, whether they just started, whether they've been here for 20 years. And so that was really neat. And at the beginning, I didn't know I wouldn't know if something doesn't work or works, but it's cool to have that mindset from the very beginning to please speak up if something doesn't make sense, or a strategy, a manager, there's something that's off. So he's very enabling in that way.
And then you see it play out, right? Like, it's one thing to say it, but it's another thing when you hear people speak up and it's like, it gets heard, it gets like worked into the process, things change. It's definitely not lip service when it comes from Dave and the way he runs his office.
My favorite episodes are always the ones when we get to speak to a team. Even if two people of many, it's wonderful to hear the dialogue and the back and forth and, checking one another and, seeing how things develop and how things grow, particularly the learning experience. So thank you for sharing all of that. I do want to ask you, Renee, what's one trend or shift you're seeing in the investment landscape that you're preparing for that maybe some others are not?
I was thinking about this because we had talked about it. And I think one of the things that we're very top of mind on is, we're trying to grow the endowment in a meaningful way. And access. We are big believers in the lower middle market and the dislocations that exist there. And we also understand it's a high class problem. The challenges that exist when you get to be above $10 billion. And so we're already thinking about, what does it look like when you go from 2 to 4? What does it look like when you go from 4 to 8? Because it's a lot, those numbers are more achievable the bigger you get in terms of doubling in size. And thinking about the duration and what it would look like to stay in the lower middle market. And so access is very top of mind for us, and how we can ride our winners as long as we can in a meaningful way.
When you're thinking about private credit, you had mentioned it, an area that you're not spending as much time on. Are there any specific reasons other than what we talked about earlier?
Ultimately, we don't like the capped upside. So when we think about the liquidity and what we're giving up, I feel like I'm not necessarily trading downside risk. I think it still exists when you think about the credit quality of these businesses and, the risk that you're taking to get these types of yields. But I'm not necessarily participating in the upside like I am when I'm long equity. So for us, it's been that trade-off.
So when you're thinking about advice, so if you do get back into the classroom and you're going to speak to another group of students, what type of advice?
When I get more free time.
Yeah, when you get more free time.
All that free time.
It sounds like it might be tough for a little while. You guys are very busy.
Yes, yeah.
But when you do get a little bit more time, so what's the type of advice you typically give to students who are thinking about a career in investments?
I mean, I just think you can really see the ones who are passionate about it and are interested. They're reading the Wall Street Journal. They're asking questions. They're following up. The power of your network. You can fill out a job application, but ultimately people tend to land jobs because of people that they know, right? And that can come in a lot of different ways. And if you're the squeaky wheel who's reaching out, sending thank you notes, following up, you'd be surprised how many people don't do that.
How about some advice that you received in the classroom that stayed with you?
To be cheesy, I think everybody says follow your passion, but I think you can really end up in any industry. And I just really liked math and went down the finance rabbit hole from there and realized, you actually can find this intersection of finance to where, marketing is important when you're looking at early stage companies and how are they branding themselves. And so for me, like that was differentiating in my career. I think you meet people at healthcare investing firms that they loved biology and chemistry when they were in college, and they didn't expect to be investing someday, but they just went down that rabbit hole, and maybe they didn't become a doctor like they thought when they were 16, but they ended up in a more fulfilling career for them. And as I've met other analysts of my same kind of cohort, another thing I've noticed is people kind of just end up in these jobs, and it's a hard job to break into later in your career, I've found. But I've met analysts at hospital systems and family offices who applied for a job on LinkedIn, and they didn't really know what it was for, and they majored in biology, but the family office thought that was interesting because they could add perspective in a different way. So I think you don't know where you're going to end up, but to just take every opportunity, apply for the job. You don't have to take it. Talk to the CIO when he asks if you have a job after graduation, and
the rest is history. Yeah.
Renee, how is it meant for you being part of the Baylor legacy? So you went to school there, you've worked there for a number of years, you're mentoring the next generation of investors. So how has it felt for you?
It's incredible to see the growth of the endowment and really the performance that we've had, and just have like a meaningful impact on seeing the endowment grow. And then, being in the classroom and seeing the students or the recipients of these scholarships, and just having been in that seat myself, it's incredible. And, I want my daughters to go to Baylor. Like, it's home. I want to keep the tradition alive, and I'm just excited to be able to be a part of it and, have an impact.
That's wonderful. Thank you for sharing. One last question for both of you. The people who were mentors to you, the people who have helped you with your career. So when you think about those mentors, who are some of the people that were most influential?
Yeah, I got to start with my dad, right? Like, he just taught me the power of the hustle and was my coach growing up, and is just a really hard worker, and, moved from California to Texas to really give us a better life and just poured into us. Dave absolutely is a mentor. I mean, he's very giving and sharing of everybody in the office. And then even going back to the CIO, he wasn't the CIO who hired me. But when Brian Webb started in 2010 and he said, "What do you need from me?" I said, "Give me a chance." I mean, at that point, I'd only been there for 2 years. And so there wasn't somebody who was a director in the private seat, and I wanted it, but I really didn't deserve it yet. I hadn't earned it. And so it was just give me a chance to earn it. And he did. And just forever grateful for that.
That's wonderful. Thank you for sharing that. How about you, Kailey?
I've had so many role models. I think people that I want to emulate what they're doing, whether they're in this field or not. I think, obviously, I think my parents instilled a really great work ethic in me and values. And my dad and I have the most interesting conversations about what he does at work and I do at work. And I've learned a lot from him. I had a particular role model in an internship I did in college who I think the best thing I took from her was she was always at her computer, even if this isn't the best work-life balance advice, but she was always at her computer. I think an email would come across and she was immediately on it. If you texted her, she responded in under 5 minutes, or else I would worry. Like, she was just one of those people that was always on it. And I think that was the first thing everybody would comment about her. It's like, oh, she's incredibly busy, but her response time is insane. She's so on top of it. She knows exactly what she's doing. If she doesn't know the answer, she's going to get back to you and tell you she doesn't know the answer. And then she's going to figure it out. And I think I've taken that in a lot of ways too. If somebody texts me, like, try to respond as fast as I can. And I think in this job, it's been helpful because really important things come across your desk and you need to be reading your emails and responding as quickly as you can. And we're such an interactive office. I think it's important to not be glued to your phone, but I think when you can be, people remember when you, even if it's a no email to a firm that we're not aligned with or don't need to set up meetings with, I think people often respond back to me, "Hey, thank you for the prompt response. I appreciate it." And so even if it's a no, I think people are appreciative of that. And that one stuck with me. And then obviously Renee has been amazing to learn from. I think someone who started at Baylor during the great financial crisis and kind of has built up this portfolio from the ground. It's cool as we have, distributions come back from managers that Renee invested in and remembers exactly the underwriting she did and why she did it. And she had those sleepless nights when investing in an emerging manager and gets to see that come to fruition. It's super cool to watch.
I apologize. I'm going to ask you to speak for your generation, but I am curious of your peers.
A lot of pressure.
No pressure, but your peers who have come out of the school the last couple of years, do you find that most of them are working in the office, or is it more hybrid work? Just thinking about some of the preferences that some of your peers had coming out of school.
Of my peers and friends, I think there's honestly a really good mix. I think, return to work has been a big conversation. So I've definitely had friends who maybe originally were in that 3 days in the office, 2 days in the office, and have kind of, reverted to the regular 8 to 5, Monday through Friday. Our office is pretty flexible, and I think we're all pretty much in the office physically every day, but there's variation within that, and there are work from home capabilities. I think a lot of my peers have similar mindsets or similar like-minded firms, I would say. But I think this point in your career is really crucial for development. And so I think if there is that opportunity to work in the office, you should take it. Mm-hmm. And you can check your emails at home when your supervisor goes home or whatever it is, if you need to work from home. But I think if you're offered those days in the office, and you might have FaceTime with some really high up people at your firm that are the only other people that are in the office every day. And that's actually really valuable, just having that one-on-one time, or even, I have friends at bigger firms who they're talking to the CFO because he's one of the only other 5 people that come in. So I think there's those softer elements that you might not realize, and that come with the flexibility to be in the office, work at home.
Thank you for that advice. Thank you both for being here. I greatly appreciate it. We greatly appreciate it. Philadelphia greatly appreciates it as well. It's always nice to have people in the Dakota studios. Congratulations on all your success. Congratulations on the role. We wish you nothing but future success. And thank you for being here.
Thank you. Thanks,
Thank
guys.
you.
Thanks, Steve.
Hello, my name is Alina, and I'm a senior at Drexel, majoring in finance and business analytics with a minor in data science. So I have one question for you. Given the current macro environment, are there any niche areas within your portfolio or overall in the private markets that you're particularly cautious on?
The one area, and I wouldn't call it niche, is private credit. So it's an area that we have shied away from because of the return hurdle that I articulated earlier. We have a 15% net IRR. We want to be able to participate in the upside, and we feel like our upside is capped with this category, but not necessarily our downside. So we want things that have an asymmetric skew to the upside. And this doesn't scratch that hurdle for us. But in general, I think regulations have gotten tighter within the banking system. And I know that's one of the initiatives right now of the current policy to potentially loosen that with Main Street banks and regional banks and smaller banks. And so if that happens, what does that do to private credit? Do yields come down? It's just something that we're kind of scratching our heads on what would be the impacts and the ramifications to private credit should that regulation end up being implemented over the next 4 years.
Thank you so much for sharing this, and I totally agree with you.
If you want to learn more about Renee, Kailey, and Baylor University, please visit their website at www.investments.web.baylor.edu. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. Finally, if you'd like to catch up on past episodes, please check out our website at dakota.com. Renee, Kailey, thank you again for being here. Steve, thank you as always for being here. And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.